Hello and welcome to a new episode of Meet is Capital. We will give our perspective on emerging and frontier markets and what has happened during the last quarter. Today is April 10th, Friday, and my name is Jacob Grapengiesser. I'm the Chief Investment Officer of Meet is Capital. With me today, I have David Nicholls, Portfolio Manager for our Global Emerging Market Strategy. So David, it was an interesting quarter to say the least. Can you please give us the rundown of what actually happened in emerging and frontier markets?
Yes, hello everyone. So yeah, first quarter of 2026 was very much a tale of two halves for global markets. I think what's interesting is you look at just the headline numbers. Emerging markets ended the quarter broadly flat. Frontier markets were down about 1%. I think it's probably surprising to many people that both of these markets outperformed the S&P, which was down 4% in the quarter. And we're also very pleased that despite all the volatility, both of our flagship funds, the Global Emerging Markets Fund and Frontier Markets, ended up with decent alpha during the quarter. But yeah, if we start with the sort of the good side in January and February, it's very classic sort of bull market conditions, particularly in emerging markets, which are up 15%. And this is really a continuation of what we saw in 2025, with investors continuing to try to rotate away from the US on concerns about weaker dollar, stretched valuations and positioning in the Mag 7 in US. And then on the other hand, in Asia, we had huge waves of chip price hikes. So for semiconductors and memory chips, that really underlined just quite how dominant the competitive position was of this very small select handful of memory producers that that really in the driving seat for AI capex. This drove huge earnings upgrades and very strong inflows into both Taiwan and South Korea. Of course, and this was amplified actually even more by retail investors, particularly in Korea. Momentum was very quickly disrupted by the conflict in the Middle East, of course, that happened basically in the last weekend of February. And at first, this just resulted in investors unwinding their most profitable trades, just taking risk off the table across the globe. But of course, this hit most the countries that have performed very well, like Korea. But as the conflict dragged on, the attention moved slightly towards this risk of higher for longer commodity prices, and what effect that would have on sort of inflation and rates and things like that. I think if you look at the specific markets, of course, the ones that have the biggest reliance on gas and oil imports were hit the hardest, which would make sense, Korea and India being the obvious ones. I think what's nice to see is China held up quite a bit better, which I think fundamentally does make sense. It has much more diversified energy supply in terms of much higher share of renewables and coal, but also more high EV penetration, of course, which reduces the reliance on oil to some extent. On the plus side, of course, the oil exporters such as Saudi and Brazil are doing well. And actually, we saw the same in frontier markets, where we have countries like Kazakhstan and Nigeria performing. But yeah, what are the sort of the main fundamental impacts of this conflict on the broader things, the broader markets? Really, these two things, and it's the commodity prices and then the impact on sort of inflation and rate expectations. We show here what the moves were in commodity prices. I think it's in terms of physical actual oil that you can buy, it was even higher than this. We're seeing that there's North Sea oil trading at a $50 per barrel premium to these Brent crude prices, based on physical settlement, oil that you need to buy very soon. And yeah, this clearly has a big effect on rate expectations. You can see here that before the war, the market was expecting a decent number of sort of Fed rate cuts. Currently, we're expecting basically none for the year, maybe even a rate hike towards the end. So yeah, and this has of course a profound impact on emerging markets in terms of their ability to lower rates. It means at least the opposite. It means likely to be higher rates, an impact on growth and things like that. So yeah, clearly not a very positive backdrop. And we will come back to the outlook. But Jacob, could you talk us through how we've handled the conflict more from a sort of a portfolio management perspective? What analysis have you been doing? What kind of trades were we doing in the quarter?
Yes. So perhaps 25 years experience in emerging markets, and many of those in Russia, has given me a bit of expertise in dealing with crisis. Let's just put it that way, right? So I think we, myself and the team, we took things relatively calmly. We assessed or reassessed every position, and if something actually changed, right, without panicking. And I think what did change was some of the markets in the Middle East. I think as things stands now, the UAE, or rather Dubai, probably will face some issues in terms of growth. Non-oil GDP growth in the UAE was around 5%. Well, if you look in the beginning of the year, right, and if you look before the US attack on Iran, you're probably going to see a significantly lower growth, maybe even a contraction in Dubai. Abu Dhabi is probably a little bit more resilient. It has more reserves. It is slightly less reliant on tourism and real estate development as part of the economy. Dubai is very reliant on those. So what we have done is we have exited positions that were mostly Dubai exposed, such as Emaar Properties, the largest real estate developer in Dubai. We sold those at, I think, very good levels, effectively levels that you saw sort of 4 or 5 months ago, or down 7% year to date, which I think is a relatively modest decline, having in mind, I think, the large impact that would have on that company. We sold Emirates NBD, the leading bank, up actually year to date. We did not sell a company called Aldar, which is a leading real estate development property owner in Abu Dhabi, because again, I think that the sort of impact on the Abu Dhabi economy will be slightly smaller. We added a position in Saudi Arabia, Saudi National Bank. Saudi Arabia will benefit from higher oil prices, and it's not under the same, let's say, attack as perhaps the UAE has been. Again, we hope that the ceasefire lasts, but it's inevitable that there is still some sort of threat looming, right? And that's probably going to be having a certain impact for years to come. We added some fallen angels. When there were significant price corrections, we bought companies that we've been looking at for a longer period of time. We thought this was a good entry point. For example, a company called ICT, International Container Terminals, in the Philippines. They are exposed to global trade, and we do expect that global trade will continue, maybe not as normal, but it will continue flowing in the next couple of months, right? So that company will also benefit. I think most of my mental energy I've been spending on a lot of the Korean names and the memory sector. So just to give you some prices here, right? DRAM prices for DDR5, which is the latest generation of a 16 gigabyte DRAM chip, are up 680% year on year. And they are 7 to 12 times above normalized levels. So if you buy the latest iPhone, it's going to have a DDR5 chips, or a couple of them inside. DDR4, which is the second latest generations of DRAM chips, they're up 2,500% over 1 year. These are clearly crazy price movements, right? So why has that happened? And why is it benefiting companies like SK Hynix and Samsung Electronics? Well, it is simply happening because for especially Hynix, they have concluded contracts with NVIDIA and Microsoft and partially also Alphabet or Google for production of so-called HBM chips, high bandwidth memory chips. And the margin on those chips are very high, and the prices are regulated by long-term agreements. This sort of squeezes out capacity for DRAM production, and DRAM sales are done on a spot basis, right? That's why the prices are so volatile. But it also means that a very significant part of the operating profit of both SK Hynix and Samsung is now coming from the DRAM part. Samsung released some sort of preliminary earnings for Q1, and 80% of the profitability comes from DRAM production, right? So these companies have been very strong, but of course, it's always easy to speak about the good news and the stock price performance, but at some point there's also time to take profit, right? So we have been significantly reducing our positions in the memory names. So yes, these are amazing price increases. Prices might continue to go up, but at some point they will also come down, right? And you need to sell probably on the way up. So we've been cutting around 6% or 6 percentage points of our memory exposure. We sold out a company called Nanya Tech, which is a Taiwanese producer of DRAM chips. They are producing the DDR4 chips, so slightly old technology chips. But we also significantly reduced the position in Hynix by 5 percentage points, and then in SK Square, which is a sort of a holding company or alternative exposure to Hynix by 3%. Just to give you the numbers, we added these companies for Hynix a bit more than 6 months ago, and we made 200%, or we made more than 100% on SK Square, and close to 100% on Nanya Tech, right? So very, very good trades for the fund, but again, it's time to take profit and move out. We also added some new positions, such as a Korean sort of tech beauty company. They are basically advanced in terms of processing natural products, and they are providing the best-selling skincare products, for example, on Amazon. They are using DNA fragments from salmon sperm, but there are also vegan options if you want that. And they are creating beauty creams, skincare creams based on this, and they reported more than 100% sales growth. Rather, the market expected them more than 100% sales growth in the first quarter this year. So again, reducing the memory part, adding very kind of stock pickish type of names, in Korea, but also in Taiwan, and I would expect us to continue this trend in the second quarter as well. All right, but David, how do things look in frontier markets?
Yeah, sure. So one of the main arguments that we've constantly given about frontier markets is that it's a completely uncorrelated source of returns, both within the asset class, so between the countries in frontier markets, but also in terms of the correlation with emerging and developed markets, right? And you saw that very much in Q1. We mentioned the benchmark was down around 1%, but actually our fund delivered positive returns. And I think which is a really good example of why frontiers can shine. And why is that? Well, of course, it's good stock picking, but it's also the set of countries that make up frontier markets is very diversified across regions and sectors and macro exposures. And a great example, particularly, of course, in this quarter would be Kazakhstan, which is the second largest country in our frontiers fund, almost currently around 15% weight. And what kind of companies do we like there? Well, it's a real range, right? Like, for example, we like a bank called Halyk, 7%. It was up 7% in the quarter. Strong market position, attractive valuation, dividend yield of 12-13%. But also we have Kazatomprom, which is one of the most interesting companies in Kazakhstan. It's world's largest uranium producer, by far the lowest cost producer. It was up 44% in the quarter as energy prices rose, and interesting nuclear power is picking up again. I actually had breakfast this week with both the CEO and the chairman of the board, who are traveling to Europe to really sort of try to meet investors, improve transparency, improve awareness of the stock. So I think they're well aware of how undervalued the company is, and really trying to do as much as they can to reduce the discount to US listed uranium producers. The discounts may be sort of 70% roughly, depending on how you value it. So we actually increased our exposure to that name during the quarter to reflect what we see as a very good outlook for the uranium market. But yeah, Jacob, it was another busy quarter for travel, of course. So yeah, what stood out for you then?
Yeah, so as always, we've been busy traveling around. Perhaps the frontier team has been the most busy, visiting places like Egypt, Vietnam, Sri Lanka. For the global emerging markets team, we had a offsite in Shanghai. So the whole team came to see various companies and brokers in Shanghai. Perhaps one of the more interesting meetings was with Hesai. This is a LiDAR manufacturer. So if you want self-driving cars or just higher safety, you basically need to put a LiDAR on it. I was recently told that it's like, you know, using seatbelts in the car, right? I mean, there's just no reason why you wouldn't have a LiDAR on your car to improve safety. I think in Europe it's not very widespread, but in Asia, I would say that all of the sort of high-end EVs now in Asia, they would have LiDARs, which is basically a sort of a laser detection mechanism for you know, seeing cars and other things on the road, right? And Hesai then, you know, for example, is expected to sell 3 to 3.5 million units of LiDARs this year compared to 1.5, so doubling sales over the course of 1 year, right? So 1.5 in 2025. And the cost per LiDAR is down to about $200, and it used to be thousands of dollars per unit before, right? So I think Hesai is a good example of the exporters, the sort of mid to high-end exporters, you know, from China. So exports grew by 22% in January and February. Absolutely staggering numbers, I would say. I think the domestic economy is still not really picking up. We're not really seeing, you know, local restaurant chains or consumer goods, etc., picking up. But the export part is where we have been focused. All right. Yeah. So David, you know, what's next? You know, where do we go from here? We had a super strong January and February, steep correction in March. April, we're sort of getting back on track, but you know, how is this year going to end?
Yeah, sure. Great question. Well, I mean, I think it's very clear that a lot will depend on the outcome of the Middle East conflict. You know, in the last few days, we've seen a ceasefire, quite a fragile ceasefire, I think it's fair to say, and constant headlines. All eyes will be, of course, on the negotiations in Islamabad this weekend with US and Iran. Clearly, there is a will to, I think, to find some resolution to the conflict, but of course, we're not. I think we'll only know when we see the outcome. I think, of course, if there can be some sort of peaceful resolution, the Strait of Hormuz opens again to all flows, you would expect that the more positive sentiment will return. But of course, that could take some time. And I think, you know, I guess our view is that for the next couple of weeks, at least, markets will remain very, very much driven by what's coming out of Washington or negotiations in the Middle East. I think it is worth remembering that the broader emerging markets narrative really remains intact. You know, so what we've been saying for the last couple of months in terms of, you know, for example, AI data center capex and second quarter chip orders for really look like they'll continue to exceed expectations. So you'll continue to see very strong earnings growth in Taiwan and South Korea. If you look at the other large market, China, yeah, fairly well insulated from the crisis. You know, very low inflation, lower reliance on imported fossil fuels in terms of their overall energy balance. And of course, our main theme in China of this idea of high quality trade is still booming. So Chinese exports were actually up 22% year on year in January and February, right, despite all these tariffs and all this sort of stuff. So I think the fundamentals are broadly intact, of course, subject to commodity prices remaining under control and hopefully falling from these levels. And for investors, you know, I mean, if you liked emerging or frontier markets in January and February, I think it does make sense that you should like them 10% lower and cheaper. But I think it's very clear that the whole market and everyone we speak to is in wait and see mode, really waiting to see the outcome of what's happening in the Middle East. So yeah, fingers crossed we get a quick and peaceful resolution. But with that, yeah, I'd like to thank you for watching, and please get in touch if any questions.